Welcome back to the channel. As always, if you copy trading, you're an absolute moron and you should deserve to lose all your money. With that out of the way, we're going to look today at a stock called Advanced Auto Parts, ticker AAP. And this is a company that I started looking as a long at the beginning of the year. And we can see, if I remove these lines, first of all, expectations on EPS and EBITDA have been massively slashed down, and the stock's been falling. Before that happened, I was starting to look at this stock as a potential long, and you can see that in the first few months of the year it did all right. I didn't enter because I wasn't convinced about the fundamentals playing out as they should, and that was the right call, it seems. So after reaching these heights in late March, it turned out that the reported earnings in June, and the company misstated their guidance, which led buyers to take profits, pushing down the stock. So obviously that's not a good look for the company. Made some investors lose confidence out there. From there, the stock continued to range sideways for the most part of Q2 and Q3 as well. And now we have this earnings report right here, which has led to massive downward momentum on the stock. Now, ideally, we would have wanted to enter this short a while ago, but I think that there might be further room for downside in this stock. So, first of all, if we have a look at the valuation of this company versus peers, we can see clearly that is not only well below, but also the valuation has moved quite a bit significantly. So while the other players have remained stable, this one here has come back to pre-discounted levels compared to peers. And part of the reason for that is because their margins are below the companies that it competes with. We can see that in terms of growth, the company has experienced little to no growth. As a matter of fact, a few year-on-year quarters in terms of revenue. The margins have remained kind of stable, but it's still very low, for example, on the EBITDA and net income. At the same time, debt continues to increase. So overall, doesn't seem like is a good picture for the company. Now, cash from operations is still rather low. And if we look at what they do, they provide automotive replacement parts. Well, this is not a demand that I kind of see at the moment from the US consumer. Primarily because we have had quite a long time of subdued demand in the auto sector. And I think the little demand that would have been generated out of sluggish auto sales is probably bottomed out. So that leaves not much room for that effect for these guys to benefit from the sales. So if we look at how that reflects into the estimates going forward, we can see again that for the most part on sales, EBITDA, EBIT, EPS, and EPS gap, they all have been deteriorating a lot. Now, the stock was due to go through a turnaround this year, and I think that's part of the reason why it went up over here in these months. But now it's confirmed that the turnaround not only is not here, but also that some of the fundamentals keep deteriorating. And that's why we keep seeing the stock this way. Now, in terms of multiple, the stock's trading at 15 times next 12 month PE. But we can see as well that some analysts, well, actually, all of the analysts are downgrading the upcoming quarter's earnings. So I see strong fundamentals here for this short to play out. Earnings will be taking place on the 15th of November. That's not a confirmed date though. But I think the current options chain provide quite an interesting structure. So we have the 18th of October. So that's a month before the expiry. And then we have December. So that creates a good opportunity for a calendar. Likely we'll be entering this at a 2-for-1 ratio, classical structure. And in terms of the open interest, we see that there is significant open interest at the current level, around 40. However, if we look a little bit farther down the line, the one that seems to be facing the most open interesting is 30. So I think that the level between 30 and 40 is likely where this is going to play out. There could be a little bit of a rebound from here. At the moment, we are very oversold territory. So I would likely buy the 30 Decembers and sell the October 30s at a 1-to-1 ratio, and perhaps add to the long side of the trade once it rebounds back a little bit. Hope you enjoyed the video. See you soon.